Why is crypto so shaky? It's the same reason tech's been shaky. It's liquidity, stupid. Liquidity is the big driver of all asset classes, and particularly crypto. It's the most receptive to liquidity injections or withdrawals. So I correctly managed to time the bottom in 2022 based around the liquidity cycle. And the forward-looking elements of the liquidity cycle continue well into 2025. So I don't have anything to concern over. So therefore, we're looking at the wiggles in liquidity.
Investors had great expectations when Bitcoin skyrocketed to an amazing all-time high, almost $73,000 in March. Many had predicted that the spike in demand would maintain prices well over $70,000, especially from spot Bitcoin exchange-traded funds. But the actual situation has been very different. Rather of seeing constant spikes and big returns, the Bitcoin market has seen considerable volatility. Let me introduce Raoul, a renowned macro analyst, passionate supporter of cryptocurrencies, and former executive at Goldman Sachs. Pal claims that the volatility surrounding the cryptocurrency market is a result of issues with global liquidity that have been made worse by the Federal Reserve's tightening actions. Pal, meanwhile, sees an indication of optimism amid the chaos, the belief that the Fed would soon reverse direction and restart the cryptocurrency bull market. Pal's observations for cryptocurrency investors include an important disclaimer. Stay away from rapid judgments, avoid leverage, be ready for downturns, and be patient while the market develops into something we can't fully understand today. In his most recent interview, Pal gives a much-needed update on the condition of the bull market and offers insightful predictions about what's in front for both investors and cryptocurrency supporters.
In the last 12 months, you've probably forgotten this, but this is our fifth or sixth 20% pullback in Bitcoin. So you've dealt with this many times before. You just kind of forget it, which is weird. And I think Coinbase put out a super interesting tweet, which was, there have been 5 Bitcoin bull markets. In an average bull market, you'll have to survive the following to ride it to the top. 6, 5 to 10% drawdowns, 3, 10 to 20% drawdowns, 2, 20 to 30%, 1, 30 to 40, 1, 40 to 70. And that's all during a bull market. So it takes a certain kind of gumption. It takes an ability to turn off Twitter, to turn off your screens and say, has my thesis changed? Is the adoption of this technology stopping? Is there any other reason that it's going to slow down? Where are we in the business cycle? I spend enormous amounts of time trying to educate you guys that this is a macro asset and it's driven by the business cycle. It just happens to be forward-looking, like technology stocks, and it's driven by the liquidity cycle. So has something changed in the business cycle that would tell us that we're going to have a failed crypto cycle? Well, in all probability, that's a no. So therefore, it's corrective price action. And if you happen to have extra money on the sidelines, use these corrections to add. That's what I did. I was lucky enough to have a bit of cash, and I added to my Solana position. Great. And I found that compounds really well over time. It's a key way to make better returns out of this space is use the drawdowns to your advantage. Even the big cyclical ones. I didn't sell out of anything last time. I had no intention of it. It wasn't that I missed the top or anything else. I knew that to get back in is really hard. If you take X sum out, you never put X sum back in again. You go smaller because you don't want to risk it all. Your whole psychology is screwed up. So what I prefer to do is say, well, this is a longer term trade. When we get the big drawdowns, I just want to add. And then you compound and you're back to all-time highs well before the market is. And that is really, really a superpower. So what's going on now? Why is crypto so shaky? It's the same reason tech's been shaky. It's liquidity, stupid. What's happening? If you think about the US liquidity, it's driven by the Fed's balance sheet, which they've been doing QT, so they've been tightening it, making liquidity less available. But that's been offset by the Treasury, by the draining of the reverse repo. The reverse repo is an offset to what the QT was doing. And in the meantime, the other part of the equation is the Treasury General Account, which is the checkbook of the US government that Janet Yellen controls. And she's been building that. But these have meant the liquidity based back in 2022, and it's been going vaguely higher. The Everything Code cycle taught you that there is no way of financing the debts. It's now become a word people use, fiscal dominance. This is the Everything Code cycle I started talking 2 years about. The Everything Code cycle says, well, if GDP growth is too slow, then the amount of debt in the system is too high. So you need either interest rates to come down or you need growth to go up. Now, growth is driven by demographics over time. There's not much we can do about that. You get cyclical growth, but you don't get the overall trend rate growth, which has been slowing. So the available GDP has to pay the interest on the debt between the government sector, that's 100% of GDP in debt, and the private sector is 120% in debt. So we've got not enough GDP to cover the interest payments. This gets really exacerbated when interest payments are high. Trend rate of GDP growth is about 1.75%, call it 2%. Whilst interest payments right now are, let's say, 2-year bonds are 5%. Okay, and if you double that, taking into account the private sector, you've got 10% of interest payments and a nominal GDP growing at whatever it is, 5. So there's not enough GDP, which is why the bond market's been freaking out.
The Federal Reserve made a significant statement earlier this week. It will slow down the rate at which maturing bond funds are allowed to leave its balance sheet without being reinvested beginning in June. The Fed will effectively be slowing down its quantitative tightening, QT, actions as a result of this. Experts believe that this action is a modest method for the Fed to loosen monetary policy, signaling that it understands the need of reducing interest rates and jumping-starting the economy. To moderate market expectation, probably the central bank is choosing to go cautiously. However, Raoul thinks that the effectiveness of this obfuscation technique is limited. The Fed will eventually have to make its plans publicly known. Powell anticipates an enormous rise in the price of cryptocurrency assets when that happens. Let's get back into Powell's observations.
And this is the issue of not having enough GDP growth. This is the everything code cycle. So what it leads to is what's known as more cowbell, which is stimulus. Stimulus can come in a number of ways. So the most obvious way is reducing interest rates themselves. That has been a typical path. The other way is the backdoor mechanism of injecting liquidity into the system. Quantitative easing is the best known one. The other one is draining the reverse repo and also draining the Treasury General account. So those tend to be those, and then there's some more coming, and I'll come into that in a sec. So where are we today? Why did we have the air pocket? Well, QT was going on, so they're selling bonds. The Treasury had started building up cash reserves because tax payments have come into the system. They come out of money market funds and go into Janet Yellen's checking account, and that's taken liquidity out of the system because she hasn't spent it yet, so it's just sitting there. She's been trying to help the market by issuing short-dated bonds. That's drained the reverse repo. But now, today, the market's reversed very quickly on another piece of news. The other piece of news was Jay Powell has said, hey, we don't want to sell as many bonds, quantitative tightening, which is we're going to ease liquidity conditions. Janet, on the other hand, hasn't said that she's going to issue more short-term bonds yet. Well, it's a bit impossible because the reverse repo is almost drained anyway. She's going to wait till closer to the election to unleash her checkbook and throw out money to everybody. And she will do that, and that will come in the second half of the year. So what she's done is another bit of magic. She said, well, what I'm going to do is I'm going to keep issuing these shorter-dated bonds, and I'm going to buy back some longer-dated bonds. And it's the illiquid off-the-run ones. But really, it's a recycling of liquidity. It's adding liquidity into the system. So Janet started to add liquidity, and Jay is making sure that he takes less liquidity out of the system. The reverse repo is almost drained. There's a bit more to go. But then it'll come down to Auntie Janet, and she will then start throwing her checks around and handing out money. There's another piece of magic coming for next year that's not on people's radar screens, which is Basel IV. Basel IV, the Basel agreements are basically bank capitalization regulations after the banking crisis. They imposed Basel III, which meant people had to hold more regulatory capital. That is code word for owning more government bonds. Basel IV is going to tighten that even further. So they're going to force the US, the UK, and the European banks to hold more government bonds. How convenient, because you need a buyer of the bonds to add liquidity into the system. And so that is coming. It starts with Europe, I think, in January 2025, and the US and the UK will come by about June, July 2025. So there's liquidity coming in the system at a structural level, i.e. they're creating another larger buyer of bonds. We will see more of those kinds of things over time, and we're going to get much more liquidity. But this is just the Fed. Over in Europe, well, the ECB want to start cutting rates soon. That's going to start injecting liquidity into the market. They're also still planning their big green energy initiative to lower the cost of electricity in Europe, which is actually good for productivity. The UK is similar. They blew up their gilts market last year. They will do some injection of liquidity, whether it's via rates or whether they can find a backdoor excuse to do something else. Obviously, Basel IV for all of these helps. Japan has got a real problem on its hands. Its currency is falling fast, and there's very little they can do. They don't want to raise rates too much because they've got the everything code issue at hand as well. So they've got this problem. China's also got the same problem. It's starved of dollars. It has a bunch of dollar debts. It has a debt deflation going on, particularly in the property sector. It's an unbalanced economy. They need dollars, and they can see Japan losing control of its currency. They're nervous about that. Janet Yellen's been over there twice because she's worried that devalues, they're going to dump deflationary goods onto the US and create other problems. So somewhere here, there needs to be an injection of dollar liquidity into the system, whether that's or some other backdoor mechanism to alleviate the strength of the dollar. I think that's going to come as well.
The study by Raoul explores the complex relationship between market forces and fiscal policy. He properly characterizes the state of the economy now as a everything code cycle, a term that captures the intricate interplay of forces influencing consumer behavior. Pal explains the idea of more cowbell, which is a figurative reference to the constant need for stimulus in the face of slowing GDP growth. He goes on to say that this stimulus can come in the form of lower interest rates and quantitative easing, which is the injection of cash into the financial system. He offers a thorough analysis of current affairs, including the Federal Reserve's move from quantitative tightening, QT, to a more flexible position. Pal draws attention to the subtle tactics used by decision makers, such as Treasury Secretary Janet Yellen's attempts to control liquidity by manipulating bond markets and cash reserve management. Pal predicts that there will soon be structural changes, such as Basel IV requirements, which will encourage banks to hold more government bonds and therefore increase liquidity. He also expects comparable actions from central banks throughout the world, such as prospective rate reduction from the European Central Bank and programs to support renewable energy. In discussing the difficulties that nations such as China and Japan confront, Pal emphasizes the necessity of constant infusions of dollar liquidity to reduce the possibility of currency depreciation and prevent deflationary pressures. In conclusion, Pal's observations highlight the complex network of international economic factors at work, as well as the critical role that policymakers play in directing the direction of the financial markets. Pal's research provides investors with essential thoughts to guide them through this complicated terrain and make informed decisions in a constantly changing industry.